May 2019, question 5b. For those who don't have the question, there is the question to be posted there. The question is to be posted there. Good. I'm hoping now you are all there. So we are doing May 2019 question 5b. We are told that Excel Limited is considering acquiring Best Limited, a firm in the same industry, in order to consolidate its market share. Best Limited has been less profitable, so it has paid an average of only 20% in taxes during the last several years. In addition, it has used retail debt, having a debt ratio of 25%. If the acquisition would be implemented, Excel Limited could operate Best Limited as a separate wholly owned subsidiary. That means 100%. This will increase the Excel Limited gearing ratio to 40%. So that means the weight of the debt will be 40%. So that means the proportion of the equity will be 60%. So the following is the forecasted financial data for Best Limited over the next 5 years. So remember, you have told that the Excel Limited could operate Best Limited as a whole owned subsidiary. This will increase Excel Limited gearing ratio to 40. So that means when you are determining the WACC, which is weight of equity, cost of equity, weight of the debt, cost of the debt, 1 minus T, we already have the weight of the debt. Because we are told that the gearing ratio will increase to 40%, the weight of the debt will be 40%. That means the weight of the equity will be 0.6. So the following is forecasted financial data for Best Limited over the next 5 years. So we have year 1 up to year 5. We are given the net sales in millions. We have the operating cost, selling and distribution expenses, administrative expenses, acceptable investment project. Those are the capital expenditure. Additional information. Number 1, the risk-free rate of return is 8% and debt is considered to be risk-free. The expected return on market portfolio is 13%. The firm leverage equity beta after acquisition is estimated to be 0.8. Now, up to that point, the information given there, you can forget the cost of equity. Cost of equity, you use the CAPM formula where the return of the security, in this case, you take risk-free rate plus expected return of the market minus the risk-free rate, you multiply by the beta. And in this case, we are given the risk-free rate. Let's go back to note number 1. The risk-free rate of return is 8%, and debt is considered to be risk-free. So that means the risk-free rate is 8%. You add the expected return of the market. Note number 2. Note number 2. The expected return on market portfolio is 13%. So you take 13%, then you raise the risk-free rate, which is 8, and then you multiply by the beta. That's note number 3. The firm leverage equity beta after acquisition is estimated at 0.8. So that means the cost of equity, it will be 12%. So that means to get the cost of capital, in this case for the capital you take for the debt and for the equity, you take the weight of equity, which is 0.6, times the cost of equity, of which we have gotten is 12, plus weight of the debt, which is 0.4, you multiply by the cost of the debt. You already given the cost of the debt. How much is the cost of the debt? You are given the cost of the debt there, which was 8%. Let's go back to note number 1. Number 1, you already told. The risk-free rate of return is 8% and is considered to be risk-free. So that one is 8%, and then 1 minus t, 0.3. I'll get the WACC, it's 9.44%. Now let's go back to the question. Note number 4. Note number 4. Note number 4. You're told that after 5 years, the net cash flow of Best Limited shall increase at a constant rate of 6% per annum in perpetuity. The corporate tax rate is 30%. The firm gross profit margin is 40%. If the gross profit margin is 40%, that means the cost of capital is 60%. Best Limited incurs fixed financing cost of 2 million per annum. The firm equity share and board are currently trading at par. Required. Determine the maximum price payable to acquire Best Limited using the discounted free cash flow. So how much should we pay to acquire Best Limited? So now let's be here. Let's be here. So first of all, we need to get the free cash flows. Free cash flow, and how do we determine the free cash flows? So we have year 1, year 2, year 3, year 4, year 5. So we have the sales, and for the sales, year 1 it's 50, 60. We have 75, 70, and 65. Then you deduct the cost of sales so that you can get the gross profit. And you're told that that's courtesy of note number 6. Note number 6, you're told that the firm gross profit margin is 40%. So to get the gross profit, you just take 40% of the sales times 50. Like in the first year, you get this is 20. If you take 40% of 60, this one will get 24. This one will be 30, 28, and 26. Then after we get the gross profit, now we raise the expenses. So in that case, we are given the operating cost. We are given the operating cost. And the operating cost for the first year is 5. The second year is 10. We have 15, and also we have 12. Also, we have selling and admin expenses. We have selling and admin cost. The first year is 10. Also, we have 10. We have 8. We have 9, and we have 11. Then also you are given the interest cost. The interest cost each year is 2. After you pay the interest, now you can get the profit before tax. So in this case, you take 20, you raise all the expenses. So this one will be 3. This one will be 2, 5, 2, 1. Those are the profit before tax. Now let's deduct the tax. And we are told that the tax is 30%. So that you can get profit after tax. So in this case, you take 30% of 3, which is 0.9, around be 0.6, 1.5, 0.6, and 0.3. From there now we can get the profit after tax. This one will be 2.1, 1.4, 3.5, 1.4, and 0.7. Again, we pay the tax, now you can invest. So you are given there the acceptable investment project cost. For year 1, the amount we can invest is 0.5. The second year, we can invest 0.7. The third year, we invest 1.6, 1.2, and lastly, we can invest 0.2. After invest, now that's how you get what we call the free cash flows. So in this case, you'll get 1.6. This one will be 0.7, 1.9, 0.2, and 0.5. Now, after we get the free cash flows, now you can discount present value interest factor. In this case, you already have the cost of capital, which was 9.44%. So it's present value interest factor, 9.44% year N. So 9.44 is not from the table. So in this case, use the formula. That's 1 plus R raised to power negative N. So and you get that for the first year, you get it 0.9137, 0.8349, 0.7629, 0.6971, and 0.637. From there now we can get the present values. 1.6, 1.46, 0.58, 1.45, 0.14, 0.32. So now let's get the total present value. So you add the total, year 1, year 2, year 3, year 4, year 5, and you get the total cash flow or the total present value. So in this case, you'll get to be an amount of 3.95. That's the total present value. So I want us to go back to the question. That's not all. We go back to the question. Go back to the question. Note number 4. Let's go back to note number 4. Note number 4. Note number 4, you are told that after 5 years, the net cash flow of Best Limited shall increase at a constant rate of 6% per annum in perpetuity. So after the 5th year, so this cash flow, and we had this was the free cash flow for year 5. We are told from year 5 up to perpetuity, the cash flows. I'm saying that at the end of year 5, the cash flow at the end of year 5 is expected to increase at a constant rate. We are given a constant rate of, that's 6%. Yeah, constant rate of 6% per annum to perpetuity. So how do we get the present value of cash flow to infinity? So in this case, present value of cash flows during constant growth period. This is the formula you use. So in this case, you take the annuity, 1 plus R, cost of equity minus the growth rate. And then since you are getting the present value, so in that case, you have to take present value interest factor, the discounting rate, and the period. Or this formula is the same, the one we used to get the PO, the value of the share, where you take DO, 1 plus the growth rate, let me call it growth rate, plus the growth rate over KE minus growth rate. It's the same. So in this case, you take the annuity 1, and this one after year 5. The cash flow after year 5 will grow at a rate of 6%. So in this case, our A, or annuity in this case, will be 0.5. Then expected to grow at a constant rate of 6%. That means our growth rate will be 0.06. You divide by cost of equity or the cost of capital. So in this case, you use the cost of capital, or you can use the rate. So in this case, our case was 9.44. So you take 0.0944, you raise the growth rate, which is 0.06. With that case, you get the value. And then, since in this case, we want the present value, you have to discount. So you discount using present value interest factor. And in this case, since you are taking from year 5 to grow up to perpetuity, they have not specified the year. So you take to have year 5. So it will be 9.44%. You use the discounting for the last year, which is 5 years. So that means in that case, I have the figures here. Which is 15.41, your discount using 0.6370. That's what you do. You'll get 9.81. So now that means the total value, you'll take, you already have the total present value from year 1 up to year 5, which was 3.95. Also, we have the present value during the constant growth period, which is 9.81. So in that case, the total value of the company to be paid is 13.76. I repeat again, whenever you are told that the cash flow are expected to grow at a constant rate up to perpetuity, this is the formula you use. You take the annuity for the last period, 1 plus the growth rate over the rate minus the growth rate, and then to get the present value, you have to discount it. Yeah, any question there? Let me give you some. Victor.